We've got another fresh business problem for Rocketblock's experts to solve in today's mock interview. The client today is NVIDIA, who's wrestling with a $5 billion question of whether or not to invest in rival Intel. Watch as our expert breaks down this complicated problem using an approachable framework to help steer the client through this challenging decision. As a reminder, if you want to get better at structured problem solving like this, you need to be practicing actively and deliberately. At the very least, pause this video after each question to try your own answer out loud, and if you're feeling brave, you can drop your structure into the comments and we'll leave some feedback on the first few folks who do so. Good luck and have fun casing.
Today's case is focused on NVIDIA, the $250 billion market cap leader in GPUs and AI accelerators. They sit at the center of the generative AI boom, as you probably recognize and know. So over the past 3 years, it has cemented its dominance in the market. Today, it faces an interesting philosophical and strategic question. Should it invest in Intel, one of NVIDIA's biggest competitors? So a little context. Intel was once the undisputed giant of semiconductors, but has struggled to regain its footing in the AI era. Its dedicated AI division generated just $8 billion in revenue last year, a fraction of NVIDIA's scale. And Intel continues to post operating losses as it ramps up investments in advanced fabs and architecture. Despite this, Intel remains strategically important to the US and a significant company in the semiconductor space. NVIDIA is now considering the unprecedented move, investing $5 billion into Intel's AI semiconductor division. Your firm has been engaged to advise NVIDIA's executive team. Should they move forward with the strategic investment in Intel's AI division? And if so, under what conditions?
Oh, got it. So this is a very topical case here. This is really exciting. So I think I've got everything down here. One thing I'd love to do is just ask a few questions because there's quite a bit of information in the prompt, and I just want to make sure I have all this kind of squared away. You mentioned NVIDIA investing $5 billion into Intel. Can you, I guess, tell me a little bit more about the goal for that investment or why they're thinking that?
Yeah, it's a great question. And there's kind of two lenses to it. So first is a financial return. So internally, they're using a 12% hurdle rate. So any investment has to clear that bar. And then strategically, there's kind of a second piece. And they believe doing so will strengthen their supply chain resilience and soften, potential regulatory scrutiny of, monopolistic power, which has been conversations going on broadly in government.
Got it. Okay, that makes a lot of sense. And there you mentioned supply chain. So I guess I'm hoping you can tell me a little bit more about the business model of NVIDIA and I guess how supply chain fits in there.
Yeah. So, I'd say each company, excuse me, tends to operate supply chains a bit differently. So NVIDIA operates a fabless business model. So its core value lies in chip architecture, design, and kind of the software ecosystem, meaning that it outsources a lot of its manufacturing to foundries, keeping fixed costs low and margins typically high. So its supply chain is global, but it's also spread across many partners. Now, this is a bit opposite from Intel. So by contrast, they run an integrated device manufacturing. So it's both designs and fabricates its chips. So its supply chain is more vertically integrated with fabs in both the US as well as Europe, and it's supported by upstream raw material and tool suppliers.
Got it. Okay, that's really clear. That's helpful. And I guess last thing here, we talked about Intel's decline. Can you tell me a bit about what led to that?
Yeah. So, Intel has struggled with more execution delays, and this is kind of run historically. So particularly in transitioning from smaller process nodes, while competitors like, TSMC, NVIDIA, AMD moved faster. So also Intel's acquisition AI hasn't scaled as expected. Its GPU and accelerator offerings lag behind NVIDIA in both performance as well as developer adoption. So, combine that with the high capital intensity of the industry and, slower innovation cycles, it's just kind of left them trailing more in this AI chip race, which has, been upon us for a few years.
Got it. Okay, that's really clear. So with that, I think I'd like to just take a minute or two and put together a structure to guide my thinking, if that's okay.
Please.
Okay. So I'm not sure if you can read this here, but basically I have three main buckets to how I'm thinking about this. The first is deal financials. Number two is the strategic rationale, and three is risks and alternatives. So just giving a little bit more info into each of those major buckets. First, on deal financials, I think getting a better understanding of the cost of this is going to be important, right? So the transaction to buy into Intel, looking at like the cash outlay, share price, if for whatever reason there was a kind of a stock related part of this transaction, looking at that and what happens if share prices jump, if news leaks, other kinds of financial and advisory costs that would come into this. Next would be the cash flows, just understanding things like Intel's revenue, the kind of growth trajectory, improvements that NVIDIA could drive if they partnered, and just looking at like what is the financial upside here. And then lastly, that profitability part, you mentioned a 12% hurdle rate before. So just considering that, like how profitable would this deal be? Second bucket, strategic rationale. So it's clear that the supply chain and these fabs are going to be very important. So just really understanding what that looks like and how valuable it could be for NVIDIA to reduce reliance on TSMC as their manufacturer now. Next, in strategic rationale, there's the regulatory aspect, just understanding how this will be perceived. Is that going to be seen more positively because they're collaborating with the market, as opposed to just seeing like some kind of domineering monopoly company in the market? And then lastly, this idea of influence, potentially, getting influence over a competitor company, and understanding what that means for just the dynamics within the landscape. And then the last bucket here on risks and alternatives, I guess building on this competition aspect, really, understanding, what it means if Intel was strengthened, what that means for the other competitors in, maybe the top kind of 3 to 5 in the market, how that's going to be perceived, what competitive reactions are going to be. I think there's an execution risk piece here, just understanding like maybe cultural dynamics of the companies. Is that going to be a fit? Management at Intel, if they've been on the decline, has there been, an exodus of key talent recently that we, might want to, we should just be aware of. And just governance in general, like if we have a minority stake in Intel, what does that mean for the level of influence we would have? And then lastly, if there's other options we might want to consider, like, partnerships or a full acquisition. So yeah, with that in mind, I was really thinking it would be helpful to basically look into this second bucket of strategic rationale. I think that seems to be a pretty key idea for this case.
I love that. And, specifically the point you made on the influence of a competitor, I think is critical and crucial when you get these kind of idea of like frenemy investments.
Here's some feedback from Ben. Chris's approach is straightforward. The firm has 2 goals, financial and strategic, and Chris's approach will help make each case for an investment. If you do happen to get a go or no-go decision, including alternatives as part of your structure, whether as a top category or elsewhere, can help demonstrate creativity. Often in interviews, as in real life, candidates and firms can get locked into the details of a specific choice, and it's helpful to consider the counterfactual of what you could do instead of what's on the table. Chris does well to include a proposed next step, and it's worth highlighting that he anchors his decision in a deal thesis mindset. His approach demonstrates not just what to analyze first, but why it matters in driving the client's decision. Finally, given that strategic considerations was Chris's number one thing to look at, it's worth considering if the strategic approach should have been his first bucket in the framework. No one's going to be upset if you make sure an investment has high ROI, but in this case, it seems like Chris's hypothesis is that strategic rationale is a bigger factor than financial return, and he could match his own framework to that idea.
And so, kind of doubling down on that second bucket of the strategy piece, before NVIDIA commits to this $5 billion investment in Intel's AI division, leadership wants to kind of step back and consider other forms of collaboration, whether it's worth considering. So how do you consider whether to pursue, an investment versus a strategic partnership versus an acquisition of Intel's AI business? So, kind of comparing the 3 against one another.
Oh, got it. That's a great question. Do you mind if I just take 10 seconds and kind of collect my thoughts here?
Please.
Okay. So I've drafted up a little table here. And I was thinking, we have these three options to consider of number one, the minority investment, number two, a strategic partnership, and then number three, the acquisition. And I'm really looking at them on a few different dimensions. Basically, the capital needs or the cost of the investment, the level of control that you would get over Intel by pursuing that method, and then this last bucket of the benefits. And I think if we get a sense of what that looks like across these three different options, hopefully that gives us a better sense here. I'm thinking if we take number one, this minority investment, and look at the cost, I mean, we've been talking about it before. The number was $5 billion, which feels like, a significant amount of money, but it doesn't feel like that's going to break the bank for NVIDIA, which is great. On the control side of things, I mean, we would get some control. Maybe we get a board seat. It feels like a pretty minority investment, so we're not going to be a controlling shareholder by any means. And then on the benefit side of things, it feels like you're going to get a good level of cooperation. NVIDIA has skin in the game with Intel. It feels like everybody has like a reason to cooperate and be a partner, so that's great. If we look at the strategic partnership aspect, I feel like the cost here feels extremely low. I mean, there's different ways to structure partnerships, but I imagine there's going to be legal fees and drafting term sheets and that kind of thing, but it doesn't feel like there's going to be a significant cash outlay at the start. So that's a pro. On the control side of things, though, you have very low control, very little influence over the other company. And then on the benefit side, it's the same thing, right? Where you have you'll have comparatively lower benefits from it because you're just less integrated. And then number three on acquisition, this from a cost standpoint is going to be very high. The value of Intel, I'm not sure what the market cap would be, but it's more than $5 billion. So it's probably, several multiples of that. But the benefits there are going to be full control, very high control there, and, higher benefits, which, that's great. So I guess when I look at these three options, the first option feels very balanced. With options 2 and 3, you get these bigger trade-offs, like the partnership or the acquisition, right? Partnership is a low-cost move, but there's less benefit and less control. The acquisition will give you total control and maximizes those benefits, but the price tag is going to be much higher, and I guess the risk higher as well. So I think all of those things would have to be weighed, and I think we'd want to get a sense of how much weighting to put on any one of those. But I'm thinking this first item of cost, feels very important to me. So I guess to weigh them more fully, it would be worth digging into the financials of what that deal could look like.
Yep. No, I think that's a fantastic way to look at it. I love that kind of like three-piece architecture.
Here's some feedback from Ben. Chris does well to not just dive in and list out random pros and cons of the three investment options, but rather to try and organize his thinking into a system to help evaluate each one in turn. There was an opportunity here to revisit Chris's original framework to inform this follow-up question. Chris touches on a lot of the same themes, including financials and strategic benefit, but doesn't explicitly make the connection back to his first framework. If the company has goals they're trying to achieve, and we're using that original framework to explore whether or not they'll hit those goals, the same framework is likely useful to help choose between the three options here. Chris does well to suggest a jumping off point to explore as a next step.
So, NVIDIA is going to kind of go forth with the financial piece. They like the way you kind of thought about it. So, considering the $5 billion investment in the semiconductor division, the deal would generate about $1.2 billion in cash flow annually, but not until year 3. Cash flows would then continue for 10 years. So years 3 through 12, you would actually see those cash flows. NVIDIA, and I think we might have covered this earlier, uses a 12% hurdle rate in order to evaluate investments. So would love your help in estimating what would be the ROI of this deal.
Got it. Okay. So there's a few numbers we just talked about here. I'll take a second just to make sure I have it squared away. So the cost cost here will be $5 billion. We know the cash upside we'll assume is $1.2 billion per year. But you said that starts in year 3. And that's going to go for 10 years after that. And then the sort of discount rate or hurdle rate we would apply here is 12%.
You got it.
Okay. So ROI. Great. Let's dig into it and start looking at some of these numbers here. My first thought here is the cash upside, this $1.2 billion. This is going for 10 years. I'm thinking because it's a decently long time of 10 years, we might be able to get away with just assuming a perpetuity. That would make the calculations a little easier too. So if that's okay, I'll assume a perpetuity. We'll take the 1.2 billion per year, and basically we have to divide by the 12% hurdle rate we have. So really what that does, we do 1.2 divided by 0.12, and that gives us 10 exactly. So that's a nice round number, $10 billion. So that's our starting point. I noticed you said this is sitting out in year 3. So I guess we'll need to then take that $10 billion and discount that back to year 1. So to do that, that's basically 2 years of discounting at 12%. So what I can do to get that factor will be, I'll take 1.12 and square it. So 1.12 times 1.12. That is going to give us 1.25. Not exactly, but I think it's close enough that we can do 1.25. So I guess from there, what we would do, we're going to do 10 divided by 1.25. So I'll take 1.25 as a fraction being 5 over 4. So basically 10 divided by 5 multiplied by 4, that is going to give us $8 billion. So that is the present value of this financial upside here. Now, the original question you asked was about ROI. So to get that, I would need to take what is the, I guess, the net cash flow and divide it by what we invested. So that means we're taking this $8 billion, we'll subtract the 5 billion cost, giving us 3. And then we have to divide that by our original cash outlay of 5 billion, which gives us a 60% ROI on this deal. Which, I guess when I think about 60% then as a ROI, I mean, in some ways that's good, right? We're making money on the deal. It does feel like a decent gamble to put $5 billion down and then bank on getting a net of $3 billion in the end. But I think it's worth noting that this is just the purely financial upside, and there's probably some other strategic or qualitative factors that we would need to weigh in here as well.
Yeah, I love the way you kind of worked with that. Very much simplified. So thank you.
Here's some feedback from Ben. For a lot of candidates, the idea of calculating present values of 10 years of cash flows starting in year 3 could be terrifying. Chris does well to stay calm and look for shortcuts that translate what could be a challenging spreadsheet problem into 2 or 3 simple math calculations. As a thought exercise, let's imagine you got this case and completely forgot the formula for discounting future cash flows. What would you do? You could start by calculating the straight, undiscounted future revenues. 10 years at 1.2 billion is $12 billion for an ROI of 7 billion over 5 billion or 140%. From there, you could signal that you understand the main idea of discounting future cash flows, which is that the future money is worth less than it is today. So the actual present value of the 10 years of cash flows is going to be some number less than $12 billion. You could then say, if given a spreadsheet, I could find the exact present value, and we know that as long as it's greater than 5 billion, we're making money, but the max is something like 140% ROI. Even without knowing the formula, you can still help drive the case forward and set boundaries for the kinds of mathematical analysis you want to be doing. More feedback from Ben. Once Chris has calculated the final ROI, he immediately switches to discussing the implications for the client. What does a 60% ROI mean? Is it big? Is it small? In the world of AI and chips growth, this number isn't an obvious home run for the client.
So I'm going to share a few exhibits in a moment. Based on the two exhibits, if NVIDIA were to invest in Intel's AI semiconductor vision, I also want to understand how it might reshape the landscape. So it sounds like positive, it sounds like there's a good ROI here, but want to re-stress that same strategy angle, which I think is exactly where you were pushing it. So again, I'm going to go ahead and share that on screen. If there's any issue, please just let me know.
Got it. Okay, I'm seeing two graphs here. I might just take them kind of each in turn. So looking at the left one, this is top 10 semiconductor vendor market share worldwide 2024. So these are global numbers, and 2024, these are recent numbers, so that's great. A few things I'm seeing, as we know, NVIDIA is the largest player here with a 16% share. And then we have Samsung at 10%, and then Intel, the target, at number 3 with 8%. And then there's another 7 companies with shares kind of falling down to 3%. I see there's a little note at the bottom. Top 10 have 67% share. So I guess we have a tail of another who knows how many companies making up that last 33%. So the market seems decently fragmented. And even though NVIDIA is the leader, they don't have anywhere near a monopoly. So that dynamic needs to be considered. And I guess the question we're being asked is, how would NVIDIA investing in Intel shake up this landscape? Ultimately, I guess we don't really know what would happen, but I can see a couple scenarios. One would be like NVIDIA and Intel really get along, they start to benefit each other and both see strong gains. It's kind of like your success story upside. And then the second one would be, maybe Intel just keeps stagnating on that trajectory that they're on, and NVIDIA's investment doesn't really yield a lot. So that second scenario, I don't think it really impacts that much on here. But in the first one with significant growth, that could grow the pie for everyone, which is good. But I think it could also shake up these first 3 companies, right? Samsung, you noticed, is sandwiched between NVIDIA and Intel. So I think, Samsung has the most to lose here. I think this investment could see Samsung relegated to the number 3 spot if NVIDIA really starts to grow. And I could see that as like a competitive dynamic we need to consider, is how would Samsung respond to this? Moving to the right, I'm seeing historical competitive investments, which is great. So we have a list of different transactions ordered from oldest to most recent. And it's showing the companies involved, the investment stake, some rationale. Maybe without reading through all of this, I'll just pick out a couple examples. Like up top, I'm seeing Microsoft investing into Apple for 150 million. It says stabilized Apple, secured Microsoft Office. So I guess the benefit here was securing their Office software, packaged into Apple products, which to me seems like a huge win. I mean, we're 30 odd years on from when this investment was made, and the Office suite is still the default set of tools. So that feels like a big success story. I'm seeing one here, Comcast investing in Hulu for 50 million stake. Streaming investment despite cable competition. So I guess they know their legacy products had a downward trajectory and they hedged by getting exposure to a new streaming platform. And I guess the last one, just anecdotally here, Delta investing in LATAM for 1.9 billion to make a strategic airline alliance. I guess I know competition among airlines is fierce. Cooperation is helpful. Loyalty to airlines is common. So it feels like a good bet. I think my takeaway here is that it seems like competitor investments are fairly frequent. And the investments that we're talking about here seem like pretty substantial sums. So at least from this list, we're seeing a lot of success stories, right? And I guess these are cherry-picked data points, and there's probably some failures that aren't being mentioned, but It shows that this kind of investment can be done and it can lead to successful results and give longevity to the investing company here. So I think it's clear that there needs to be a strong strategic rationale. This table actually doesn't say anything about financial outcomes of the investment, which I guess leads me to think is not really the main point. But it would be worth exploring like what kind of strategic rationale would be most beneficial for NVIDIA in this case, investing in Intel.
I love exactly where you're going with this.
Here's some feedback from Ben. This page contains a ton of data, especially if you're interviewing at McKinsey. It's not uncommon to get 2 to 4 exhibits at once and be expected to translate into implications for the client. Chris does well to stay poised and take the info in one bit at a time, building up his insights and driving towards implications for the client. Chris does well to acknowledge that the second table might have cherry-picked some data and doesn't include financial outcomes. When given qualitative intelligence or lists, it can be helpful to consider what isn't being shown. Finally, when presented with a lot of data, newer candidates can lose the forest for the trees. The premise of this case is straightforward. Should we invest or not? As Chris is scanning this mountain of information, he's always looking for reasons to make the investment or not make the investment, and he's not just calling out any random fact that catches his eye.
So I'm going to take that down. Thus far, we really have looked primarily at the financial side. Yeah, we've dabbled a bit in the strategy piece, but if NVIDIA, they're highly focused on strategic rationale now, given they do want to potentially move forward with this. What additional strategic reasons might NVIDIA have for making this investment, and how should we factor those kind of more qualitative elements into the more quantitative analysis we've done thus far?
Got it. That's a great question. Do you mind if I take just 10 seconds to come up with an approach here?
Please.
Okay. So I've thought of a few different buckets that would be helpful to think about this through. One is that the fabs and the manufacturing aspect. I could see procurement, I could see sales and customers, and then lastly, I think there's a regulatory dimension here. But that first element of fabs and manufacturing, given the different business models where NVIDIA has a fabless model and doesn't own their own fabs and manufacturing, I think this would really give optionality to NVIDIA for manufacturing locations, right? So potentially they can use Intel's fabs. It could help broaden them away from just using that one supplier of TSMC. So I think the location flexibility and then also the manufacturer flexibility is something I could see being very helpful. On the procurement side of things, I could see, anytime you're talking about companies coming together, I feel like the synergy and kind of cost synergy aspect is something that can bring a lot of value. So maybe they could integrate parts of their procurement together, getting bigger discounts or bulk buy discounts. And then also some of the back end support and marketing. I imagine that stuff is fairly minor. But any kind of combining support functions I think could be helpful. Moving on to number 3, I was thinking sales and customers. So basically this would be that idea of growing the pie of the industry. You could potentially sell to more customers. Maybe there's cross-selling to the customer bases of each other's companies. So basically it's growing the industry's pie or also growing your slice of the pie. So maybe you're taking cross-selling to Intel's customers and that were previously served by Samsung. I don't know. But that one I think is powerful. And then lastly, the regulatory dimension I think is important here, right? This industry gets a lot of attention and a lot of scrutiny right now. And even though NVIDIA isn't a monopoly, they have a 16% market share, but they are the industry leader. I feel like they're going to get outsized scrutiny as the industry develops. So I think this could potentially help with that. If they're seen to be collaborative with others in the ecosystem and they're not using their position to, crush competitors, that can only be helpful from a perception standpoint.
Yeah, I mean that outsized kind of regulatory scrutiny versus the 16% kind of putting that in scale is such an excellent point. And you discussed it very well.
Again, Chris has a strong structure on what is a wildly open-ended brainstorming question. Chris does well to share specific examples and references outside information at this moment in the case. When sharing solution ideas, especially in open-ended brainstorming, specific examples of where things have worked either in your own experience or in cases you've seen as a part of school can help promote a response from these are the random ideas the candidate has into these are the candidate's historical citations of what's actually worked in real life. That second category has a lot more weight than random ideas off the top of your head.
So, your firm has been brought in to present its initial findings. Leadership team from NVIDIA is ready. Would love having you led the analysis to understand what is your final overall recommendation.
Amazing. Can I just take a couple seconds to collect my thoughts here?
Please.
Okay. So we were asked to look into whether NVIDIA should pursue a $5 billion investment into Intel. My current recommendation is yes, I think they should. Financially, this yields a 60% ROI, which isn't a home run, but it is a respectable return. And additionally, there are many potential areas of strategic value that this acquisition could drive. We're talking about market growth, procurement, supply chain resilience, regulatory de-risking. All of that is really, really important and very valuable. From a risk standpoint, I think something we haven't spent much time discussing is the potential for strengthening Intel too much and maybe making them more of a direct threat to NVIDIA's business potential, like IP leaks or that kind of thing. So I guess as a next step, I'd recommend looking into some of the guardrails and protections that you would need to make sure that NVIDIA doesn't, they're not truly exposed to that downside risk.
Excellent. Chris, thank you very much. Appreciate it.
Here's some feedback from Ben. Chris does well to lead off this recommendation with a super clear, yes, they should. This case was a go or no-go decision, and when you get to the end of 30 minutes, you should be absolutely clear about whether or not we're going or not.
Hey everyone, it's Kenton Koveski here, the founder of Rocketblocks. Thank you so much for watching this mock interview video. I hope you found it informative and helpful as you are getting ready to prepare for your own interviews and hopefully landing that job offer you are excited about. We have a ton of great content on the Rocketblocks channel coming out on a weekly basis, mock interviews, mini lessons, and chats with our Rocketblocks experts. So if you haven't subscribed yet already, please do so. There is a big red button below. And if you hit that, you'll get all of our content as soon as it comes out. Thanks for watching and have a great day.